Welcome to the Industry Angel Podcast. We hear from the best business minds across the globe. Entrepreneurs, social influencers, marketing mavens, and sales rock stars. We've got them all. Here comes your weekly dose of inspiration with your host, Ian Farah.
Welcome to episode 73 of the Industry Angel. It's 1 degree C outside as I talk. Winter has certainly kicked in. That means I'm looking forward to all the Christmas bashes, and we'll be having another live episode 12th of December, this Tuesday, at Campus North in Newcastle. It'll be around 6 o'clock to 8 o'clock. We'll even feed and water you, courtesy of Campus North and Gym Plan. You'll remember we interviewed the co-founder Paul in November's live episode. Well, Paul loved it so much, he's invited us along to his patch. I'll be chatting with the founder of Nibble Apps, Andreas Cambanis. It's sure to be a great night. Head over to industryangel.com/live for your free ticket. I'd love to see you there. If you're going, drop me a tweet, Ian_Farah. Let's make sure we meet up. I want to hear about you guys, what you're all up to, what next year's got in store for you. So let's celebrate Christmas together. Okay, let's hear from today's guest. Today we have investor and advisor. Welcome to the Industry Angel, Doug Scott.
Hello, hello.
So, investor and advisor, does that sum you up, Doug?
Not so much anymore. I've done a lot. I've set companies up. I've ran stuff in banks. I've been a bum around the world, and now I'm actually just in the stage of about to do nothing.
Right, well, so I could have said, today we have investor, advisor, and a guy who's bumming about doing nothing.
Yep.
Doug Scott. Yeah, cool, love it. So, your accent, Doug, right? I need to get this in because you're a North Shields lad, aren't you? So you're across the Tyne from me in South Shields.
Yeah, I'm the better part.
The black and white part. But I won't go there, will I? So, but you're not here, are you? Where are you?
North of Birmingham, between a place called Lichfield, between Birmingham and Derby.
Right.
I've lived all over the world.
Right. So, listen, today, Doug, right, no pressure, but I want you to be a myth buster, right? An oracle, an all-round guru on investment, okay? The reason why, because a lot of our guests come on and they mention investment and they say it so casually and they drop these terms in like angel and VCs and I'm all about giving value on the show. So for listeners, I'd love it to go back to basics and just explain the whole investment thing, what it is, types of, etc. How does that sound? Is that okay?
Yep.
Good stuff.
Where do you want to start?
Well, I'm going to go really basic. But my friend, I always want to start a little bit about the guest. That's where I want to start. So would you mind telling me a little bit about you first?
I was brought up in North Shields. I lived there till I was 16. My school's on the banks of the Tyne, so it's not one of the nicest schools in the world, which is an understatement. Great place to grow up, though. I then went off, spent a chunk of time doing bits of jobs, drifted, and I will say drifted, into doing a degree at Nottingham. So I did theoretical maths and electronics. And then I left, and I'd already had scummy jobs beforehand, and I went off around the world and sold hot dogs, washed dishes, literally did anything that would make cash. So spent a chunk of time in the States, Australia, chunk of time in Indonesia, Asia, China. This is all, late 80s into early 90s. 90s, by luck or judgment, ended up in London doing some base projects in investment banks, which after a few years of doing it, I quit. I was running some projects rationalizing data centers, and I went off and I spent another 5 years messing around and got into the web late 90s. I was doing various things. I was buying furniture in Asia and shipping it back to the UK. Decided to put it online. Didn't understand anything about websites. 1998, got a copy of Microsoft Front Page, built a page, couldn't code, then thought, I wonder if I can get anybody to visit it. Some people came, I got a bit of traffic to the site. Some mates asked if I could help them do the same, a bit in Oz and a bit in the UK. And I did that whilst messing around the world till 2003. By that time, 2003 came along, I went, well, these people don't seem to understand what I'm doing. I knew a little bit about car hire, so I ended up buying a domain for £10 called carrentals.co.uk, which I launched in 2003, which we turned into a comparator, has rented in excess of 1 million cars now. And then just started playing more online. So we did some stuff with Expedia. We were sending them 100,000 visitors a day, just to shop in holidays. Built discountvouchers.co.uk using similar models, bit of SEO, bit of SEM, paid search, email, anything that did. Grey, black hat, any technique you could think of that Google decided that, now they're all not allowed, but they didn't really care. That
must have been with a team though, Doug, was it? You had a team behind you doing all those?
Yes, it started off as me. It grew in 2003. There was 3 of us. It became 4. There's now probably 70. At our peak about 2 years ago, we'd grown to 120. We started doing some shopping businesses in the US, doing PPC. So we built some BuzzFeed businesses. They still do. They do between 1 and 5 million people a day now touch sites we own. We probably have about 20 of them around the world in different sectors, different categories. I started angel investing because I bumped into John Bradford, who went on to run Techstars in London. John asked if I could do some help before Techstars even existed. I helped him a little bit. Then I helped Paul Smith, who set up Campus North and Ignite Newcastle. And a lot of that was done, in Malmaison in Newcastle. Me and Paul were sitting in a bar, and he was trying to explain what he was trying to do, and I was telling him all the things that he was going to get wrong. And I said, well, I can help you fix some of the problems I know. So I started helping him. I actually didn't do much, if I'm perfectly honest. All I did was introduce him to some smart people some people who had a lot of money and wanted to do something. And out of that, Ignite, I think it was Ignite number 2. Ignite 3 started because we helped get the money. Because of that, Paul opened Campus North, with Tristan and John and a few other people involved, and Lindsay. And that morphed into what it is now, still in Newcastle. And I then, some of the people I met on Ignite, I invested in, and I was helping them and advising them. Then I did some more with Techstars, and then I realized that you could actually growth hack angel investing. So we did all the tricks we'd learned on how to get traffic from Google or Facebook or Twitter, and we started doing that to find startups and to find investors to co-invest with. AngelList appeared, so we decided to semi-growth hack that as well, and we built that to be the biggest syndicate in Europe. There's various problems with how AngelList worked, but it worked at building it. I then went on and advised in I think I'm north of about 60 startups now. And then I did Techstars, Entrepreneurs First, Ignite. So all the accelerators, I was either an advisor on the board or I was an investor somewhere. And then about a year and a half ago, I realized that investing, they had become, all these people who had started off wanting to help just because I liked them, they'd become an investment, a sort of commodity in my investing strategy. I had 3 staff helping me then. And also I'd become a commodity in their system. And I made a decision about just over a year ago to stop. It was just a game I didn't want to play. I was quite happy to play, but I didn't like the idea of just doing it as an investment setup. Unfortunately, because I still have, all the companies I set up, I wasn't, as I call it, I wasn't sucking on the tit.
Yeah.
Angel and investor, nice people, but some of them are sucking on that they're being paid a nice salary to effectively do a job that they detest.
So, Doug, if we just wind about a bit about angel investors, so angel investor, would you mind just telling me a little bit about what that would look like? So, who are these typical people, and what do they do? What do they want to get out of it?
Who do they? The most
I know
of
it's a
the
broad
angel
one.
investors I know are they all financially, they probably don't need the cash. Okay, so they've done quite well financially somewhere else. They're They like winning. They like a game. They like some amusement, and it's a little bit of a scorecard of something to do. It doesn't mean that they're just going to give people money for the sake of it, but they'll give people they like money if they can help them. The angel side, most of the ones I know are genuinely quite nice people, and they just want to help. And the scorecard is, can they invest in, 2 or 3 people that nobody understands, nobody gets, and can they help them get somewhere? And I always used to say to people when I used to invest, as it's a conveyor belt. You need to tell me where you need to get off. So, going into the technicalities of it is, if I'm investing in a massively high risk business, I assume it's going to fail. I'm going to do 10 or 20 of those investments because I know the chances are, I need the odds that one might work. And what I'm going to do, my goal is to pass you up the supply chain. So that means my goal is to get you to the VC who matches what you want with the money that you want. And their goal is exactly the same, to get you up the supply chain to somewhere else.
Those 10 and 20, Doug, that angel investors might want to take a punt at. How do you kind of do that? So someone's got to be first. So do you suddenly sort of say, right, I'm going to pick 10 companies and invest in them 10 and that's me gamble? Or do you pick one and try and find another one and 2? And do you actually go in bulk?
I did it under a mathematical model. There's a modeling called Monte Carlo modeling, which basically talks about that the more you invest in, the closer you get to the average. Okay, so if you look at typical investing, if you make one bet and it's high risk, the chances are you lose. If you make 100 bets and they're high risk, there's a chance that you'll win because 1 or 2 of them will be outliers. You'll hit a Google or Facebook if you're lucky.
Mm-hmm.
Right? And that's basically the game. Different people have different ways of playing it. Mine was lots of little bets in lots of interesting people, effectively when everybody else didn't like them.
Really? What do you mean? Don't like the product or the person or both?
The model is quite simple. Is to win properly in angel investing, you either have to have a big enough stake and to control what's going on. So you might make 5 investments, and they'll be quite safe investments.
Mm-hmm.
Or you make 100 contrarian investments, and effectively you have to go against the herd and win.
Okay. When you're making an investment here, you're obviously putting some money in there, and you said you were betting small. Probably that's probably relative, a small term. But what do you get out? What do you get out of that? Are you taking equity in that business? You're taking a share option.
Yeah. So you'll take it. Investment valuations have gone up now in the UK because of SEIS and because there's also a plethora of money around now. I know it may not seem it in the Northeast, but in the investment circles, there is so much money, it's ridiculous.
What do you mean by that? Private people want to give money to you?
There's a lot of people with spare money who have nowhere to put it. You can't go and put it in the bank because you're going to get nothing.
Yeah.
So they're looking for a home. So they're more willing to take risks. Now, if you go back to 2012, say 2011, when I started investing, very few people were willing to take risks on, mad ideas with mad people. And hence, if you go back then, a valuation of a company might be £500,000 to £1 million. And let's say me and a group of mates would put £100,000 together. And that would give someone a year's runway.
Yeah.
And when you're investing there at £500,000 to £1 million, they really don't have much. Right? You're betting, I did so many investments on effectively sitting in a bar with someone and just going, I like you, and you're quite smart. I actually don't quite understand what you're trying to do, but I'm in for the ride.
Okay. You mentioned about runway there. What is that runway doing? Is that allowing the guys in the business just to pay themselves to get this product off the ground?
When I used to invest, that's what I was looking for. I did investments off pieces of paper sometimes, where someone, no deck, where someone had literally wrote on a piece of paper in a bar, and explained how they thought the world should look.
Yeah.
Most angel investors won't do that.
So let's say that 100K that you and the guys put in there to get this product, this service, this whatever it is off the ground, is it literally just to pay 1 or 2 or 3 people within that business a salary for the year and see where it gets to at the end?
Basically, that's it, yes. So the idea is if you've got, let's say it's £150,000, because under tax rules under the UK, there's a massive tax incentive for angel investors to be allowed to put £150,000 in a company. So there's a big tax break for doing that. So what you do is £150,000, I would say to people, that's probably going to give you a year. Right? Let's work on it's a year, and you have very little now. You need to hit a mile point. You need and you need to do it by the end of 6 months, because at the end of 6 months you're going to have to start preparing to raise some more money.
Okay.
Right, and it's going to take you 6 months to raise the money. Now everybody thinks it's going to take 2 months. Right, it will take 6 months. It always takes 6 months. Mainly because you have to get lawyers to do something. You have to get investors. Let's say you're trying to raise $500,000 at the next round, and you're trying to get, 5 investors together. They're going to be on holiday. They're going to not like the legals. There's going to be a debate, even when you've got them all together. I used to call it herding cats.
Yeah, yeah. You know those cats then, do they need to get on? Do they know each other?
By the time we finished, I had a group of probably 10 or 20 people who were friends. We would all trust each other. We'd all know each other. Nobody was trying to stiff anybody. And then there would be probably another group that someone else would know, and there might be a bit of random money on. It depends on what stage it is. But I think one of the things that startups don't realize is that angels and VCs all know each other. They all operate in little packs, the same as in everything else. I have friends who will ring me up and go, Doug, you're really good at this.
Yeah. Can
you have a look at this as a favor to me?
Sure.
And I've had 2 calls this week with people who are just like, we're looking for some money, and I think founders seem to think that we all operate in isolation and don't speak to each other, and it's so far removed. I've been on holiday with VCs who run big venture capital firms, and we're mates in the bar.
So, when you mentioned that valuation, so where does that valuation come from, though? This is a new business. You've met them in a bar. You've talked about it on paper. You guys have put in 100, 150K or whatever. How do you get the valuation from that business?
At the initial part, it's sort of, you're almost making it up.
Okay.
But one of the things to work out is and I've done this so many times with founders, is what do they want? Because everybody talks about having a billion exit. I hate it. I think what a load of, rubbish.
Well done.
Because no one ever gets there. The reality is this. There was 4 companies in Europe last year made $1 billion valuations. And so the first part is making up. The real game is to give them enough money to not mess up. There's 2 parts. Is one, to give them enough money to be able to build what you think they can build. And the second part is giving them enough money and allowing the founders to keep enough of the shares so it doesn't mess up for other investors. So when you pass something up the conveyor belt I talk of investing, if I own 60% of your company, the next people I give it to in the chain, the next investors won't touch it. Because what the view is they will take 20%, say, of the company, and the founder won't have enough of the company to make him incentivized to do any work. As a figure in the air, I would always say that on a first round, the founders shouldn't lose more than sort of 20% of the company. It's a finger in the air number.
Mm-hmm.
But what it meant was they still had enough of the company that actually they were, it was still their company. It wasn't anybody else's, it was theirs. And if you do it again and you get another round, by the time you get to a VC round, the founders have still got to have 50, 60, 70% of the company. Because at this point, you've got something interesting.
Yes.
But let's put numbers on it. Let's say, you raise £1 million and it's a 5 million valuation. Let's call it 4 million for rounding numbers easier, right? The VC is going to take 20% of the company. Now, if the investors before have got 20% of the company, it means the founders, and there'll be 2 or 3 of them, are still holding 60% of the company. They still have a massive, massive say in what that business does. But also they have £1 million in the bank, which is going to last them another year or 2. So if the planets align in a year or 2's time, that business could be worth 10 or 20 million pound, and the founding team are still owning 60% of it. So the founders aren't going to leave.
Do you think, though, that the founders, once if they've got angel investors, okay, do some founders just want to go along with the ride and get someone to pay the wages, or are they actually looking to make this work? I mean,
normally, if you do a VC round, normally how the stock gets attributed is you actually give the stock back in. So let's say it's, Ian's industry company.
Yeah.
What happens is, if you raise £1 million off me, you will not own your company anymore. Right? Your shares will be held effectively in an escrow. And every month that you work on the company, you will be entitled to get some of the company back.
Right, okay. Yeah.
So we may have agreed that you've got 60%, but it may take you 4 years to get that 60% back. So if you leave at the end of month 1, right, as a VC, your shares come to me.
Yeah.
And if you have other founders, the shares go to the other founders as well. It's not an unusual thing to happen.
Yeah. So that locking in then, does somebody ever walk on month 1 halfway through the year and just, I'm done?
I would say quite a lot.
Really?
Yes. I think because once you get £1 million of somebody else's money, right, people don't give you £1 million and not expect anything.
Yeah.
They expect their pound of flesh. So, and they've given you £1 million, they'll say, right, what's the plan? Let's execute per the plan. And they will the good ones will sit in a room with you and say, come on, Ian, you said you're going to do this, mate. And what happens is, it's normally not the VCs or even the angels that have people leave. It's normally the founders just walk.
Yeah.
Because what they realize is, they started off on this lovely game, of this game of startup world. And they have this, I call it's quite naive. They have this naive view that people just give them money and not care.
Yeah.
And what happens is, they get 6 months in or a year in and they realize that actually, this is really hard. They've been living on nothing. They've been working 18 hours a day. They can be stressed to the eyeballs. And then they've got someone else turning up once or twice a month saying, well, come on, have you done what you said you're doing? When the world is flying and everything is brilliant, right, it doesn't happen. People hang in. But as soon as the wobbles in the road happen and things go wrong, you have, internal fights, disagreements, and people just walk out. There's numerous companies I'm involved in where one of the founders has just walked out the door.
You mentioned that £1 million. What does that look? Does that just go into the bank account of the company? Could they draw on it, or does it sit there? Is it locked in? What's to stop them taking it and running, or paying themselves a crazy wage for a while? Or?
Yep, depends on how it's been set up. So sometimes it's legally set up that it can only be drawn once. Sometimes you mightn't even get it, so it might be agreed, but all the money doesn't arrive then.
Mm-hmm.
So it may be that you've agreed £1 million, but you're only getting 200,000 for the next 6 months because you said you only need 100 of it.
Yeah.
Sometimes it goes in the bank account, and again, it depends on who the investor is, and some people just put the money in and forget it. Now I fall into the same camp in quite a few where I've literally, I put more cash into some companies, and I just trust that the system works. And I trust that there's other people on the board who care more than I do.
So this kind of Dragon's Den scenario where people often see that. I mean, from your point of view, what does that look like? Do you sit there and watch that and laugh and you think, no, the valuations and how much they want per percent per what they're asking for? Is that true to life?
Well, I think they operate. I think some of it's wrong, because lots of the deals I know are definitely done by just people who just like other people.
Yeah.
They don't look at the business. When Dragon's Den, they go through all the numbers with a tooth comb. I know investors who will do that, but it's not to beat people up. They're trying to say, you need to work the plan out properly. Right? Like, I never invested on a plan in my life. My view is early stage investing, who knows? The world will change in the morning,
Yeah.
right? And your plans will go out the window. Maybe I come from a different place. I've been an operator. I've built numerous companies. We run companies now that are not anywhere near what we thought we were going to build. So I understand that the wheels will fall off the cart. So I've always been, mine was always, are you quite smart or smart enough? You don't have to be a genius, but you're smart enough. Do I like you? Do I actually want to help you do something? If I do, okay, I can give you a lot of introductions, and I used to say to people, all I'm here to do is tell you there's a tree round the corner, so don't crash into it. And the only reason I know that is because I came here yesterday and the tree was there.
Mm-hmm.
Right? And sadly, I've seen a lot of people who just completely ignore it and crash into a tree. But
yeah,
that's the game.
Do you think that's because it's the nature of the beast? So let's take techies, for instance, and I'll generalize massively, and I have done many times on this show because I've worked in software. But some of our developer friends are not very good at taking that kind of advice or like commercial advice. Am I going to get my hand slapped here or?
No, I've got a lot of tech. I'm pseudo tech, but nowhere near to the extent of some of my staff.
Yeah.
I think it's a different skill set.
Yeah.
Right. As someone said to me recently, to be good at tech, it's quite a linear process. Right. So you go from A to B to C to D. But when E, F, and G aren't on the board anymore,
mm-hmm.
and your mind has been trained, and generally these people, techies are mathematical thinkers, and they've also, programming is an in-out, 1 + 1 = 2. So you can see the steps. But when someone takes all the steps away, and the world changes overnight, what do? So when I used to do lots of my, I suppose, angel investing and interviewing or chatting, I'm sure so many people used to hate me because they would come with their hour presentation and a deck, and they'd worded it, and they knew exactly what they were going to say.
Yeah.
And I would get their deck, and I would flick through the deck in about 3 minutes. And I would go, okay, this is what I think you're building. Am I right? And I would play it. And then after that, after about 15 minutes, I would say, let's talk about something else. Do you play football?
Yeah.
Who do you support? And what I was really trying to do was, how good are you, this randomness? Because if you can end up, and I did numerous investments where I ended up all day with someone having debates about, politics and everything. And what you're doing is it's fascinating and you learn a lot, but also you're getting a feel for them and you're like, wow, these guys are really adaptable.
So thinking about some of those investments then, is there any ones that you can say that have been really successful that you didn't think it might have come off and it has done? I don't know if you can name names or whatever, but...
Well, I'll name one that's just gone... I'll name one, this is an interesting one that's just gone bust.
Right, okay, well,
but I'll name it because I don't know if you know, gin came out of Newcastle originally.
Yeah.
Okay. So 3 Spaniards living in Newcastle. I meet them in Newcastle. I have a little bit of banter about 3 good-looking Spanish guys going around the big market drinking and how much fun they may have. Right. And anyway, we keep in touch. And then I meet them in London one day at King's Cross, Starbucks in King's Cross, and they tell me they're going to do instantaneous delivery of anything they want within an hour. At which point I was like, you're mad. Because all I see is logistic problems.
Yeah.
I said, look, I'm in London again next week. I meet them the week after. They say, look, we bought a motorbike and we've started.
Oh my God.
And I was like, you really, and Leon, who was the CEO, I was like, you are just an idiot. And I was in, okay, how much do you want? Tell me what you're doing. And they tell me the numbers off the 1 week they've done it. And I was like, this is interesting. And it was interesting because nothing worked. So all they had was that people kept ringing them and texting them, asking if they'd pick things up. And they had one motorbike between the 3 of them. And I was like, this is viraling beyond belief. I'd never seen anything like it. There was such a demand for the service. even though it didn't work. Right? And they went on to raise, I think the quoted number is about 20 million. And they went bust last month. And fun, there's lots of like insider stuff that I know about that went on. But fundamentally, that business got into a war with Uber Eats, Deliveroo, and Amazon.
Yeah.
Right? And so if you look at it from everybody who invested early on, it was like, wow, because there was no one else there. And the game became as, how fast can you grow? So the guys go out and they end up, say, they raise 20 million. And then you hit a point where you try and raise more money. And Deliveroo's raised 500 million.
Yeah.
It's not even quite in your space, but it's close enough that the world thinks it is. Now imagine going to try and see a VC who's like, how much do you want? And you're like, well, we need 50 million or 100 million more. And they're looking at it and they're going, you're going to have a war with Amazon and Uber. Deliveroo's like a little forgotten child in this war.
Mm-hmm.
And then you have Gin, that's, the forgotten child.
So what about all that investment that previously had occurred, though, that these guys have went bust now? I mean, did the investors get some money along the way and along the journey, or is it all gone?
No. The game is the exit's the only thing that matters.
Okay.
So you're looking either for, and you're not even looking for a P&L exit. It's not based on a profit and loss most of the time. You have a strategic exit. So something like Magic Pony that raised money in London, and 20 months later was sold to Twitter for 150 million.
Right, okay.
It's all about where's the strategic exit, which makes it really hard to exit, which is why I sit with lots of people and I say, look, if you're going to play this game and you want to build it big, you're in this game for 10 to 15 years if you get it right.
Are you talking about the founders or the investors?
No, the founders.
Yeah.
The investors will pass it up to the chain to the next person.
Yeah.
So
and then exit what they wanted to exit at, yeah?
Well, no, they won't exit. They'll ride the horse as well. They might take a little bit of exit off the table.
Right.
So if you look at, I was out with two VCs this week having breakfast, who are just mates. And they're big, like 100 million plus VCs. And effectively their job is they will spend 2 to 3 years spending, let's say, half of that money. So if I'm rounding numbers. But what they'll do is they'll take 100 million of mostly institutional money. So it might be British Business Bank now, it was European Investment Fund. A huge amount of EU money was flooding into venture. And what would happen is if they've got 100 million, and what they will do with that money is their model will be to make, you got to think is from a pension fund. The pension fund will take 3 to 5% of its total portfolio. And it will take 3 to 5% of that and it will put it in high risk investments.
Yeah.
And what it's looking for is it's looking that it'll get its money back or it might make a little bit. And there might occasionally be an outlier that's a Google or a Facebook where, the 5%, let's say the 50 million they put into venture becomes 500 million. So it's a very small amount of a pension fund's asset class. What they'll do with that is, my friends have got 100 million fund. They will probably invest in 30 to 40 companies over a 3-year window. And they will put, let's call it £1 million in every one. Then they will keep the rest of the money. And of those 30 to 40, probably about a third of them, if they get it right, will get on to raise more money. So they'll go and they'll try to raise 10 to 20 million. And what the guys will do with the 60 million they have left is they will use that money to reinvest in the companies that are there. But it means when you get the 3-4 years in, they're no longer the driving force on the board. The new VC who's just come along and put 10 or 20 million pound on the table is now the guy who's at the table.
So how does that share option look like? So you've got someone who's put 10 in and this guy's put 1 in and there's been angels before that. Is the share just getting split all the way?
All the way down. So the best one I probably have on a current valuation, what did I do? Let's say I've got one. I've got a simple example. £25,000 into it at £500,000, 600, 700,000 pound valuation. And a few friends put some money in, so we put 100,000 in, let's call it, and we own 15% of the company.
Yeah.
That company goes on and it raises, the next round is a 5 million valuation, and it raises $1 million. So I lose 20% of my shares. Now I have an option of reinvesting to keep the same shareholding. So at 5 million valuation, I might reinvest. It might cost me another 10 or 20,000 pounds just to keep my holding. But let's say it goes on and the next valuation is 100 million and it raises 20 million.
Mm-hmm.
There's almost, there's no point in me investing at 100 million valuation, because the person who invested 100 million valuation is looking for the business to be worth maybe 300 million.
Yeah.
They're only looking for 3x. So they're only going to do a few deals a year, right? And chances are, assuming they're reasonable at it, they'll get 1 in 3 of them will work. Whereas my model earlier on is, I might get 1 in 10 of them will work. 1 in 10, I'll be lucky.
So when that VCs come in and put that big money on the table and you've decided like that's, you can't compete with that, you said you'd lost your shares?
No, you dilute. So I would lose, if they take 20% of the stock or the cap table, I would lose 20% of mine, as would the founders and as would everybody else.
These VCs have come in and put 100 million down, then suddenly you expected to have 20% and now you don't. That's been diluted down.
Yeah, I just look at what's the real value.
Yeah, because you were always saying you were always interested in pushing
I put £25,000 into, let's say it was valued, let's say it was 600,000 or 700,000.
Yeah.
So at that time, I'm sitting on, 4%. Right? That company now is probably I was worth 25,000. That company is probably worth 30 million now.
Yeah.
I now own 2%. So in theory, on paper, I'm worth 600,000. I don't care what my equity position is.
Right.
Let's play that. It gets diluted another 3 times.
Yeah.
And I have 0.1%, but it happens to be Google.
Yes.
The real money terms is a bit of a who cares. There is one of the things that it's fine if they go really big, and it's fine if they collapse and die. The middle ground is where the funny ones are, because as a venture capitalist, what you'll do is you'll put preferred stock in the way. So you'll have a special class of share that allows you to be paid first in an exit.
All right. Okay.
So let's say a venture capital puts £20 million in.
Yeah.
And then the company 15 years later gets sold for £20 million. The VC gets paid first, right? So they get all their money back. I get nothing. The founders get nothing as well. So it's one of the debates. If you look at Uber, Uber's valuation of 70 billion.
Yeah.
That's great, but they might be someone like the Saudi Wealth Fund who just funded it. Let's say they might have put 5 billion in, but the terms of that deal may be that they get the first 20 billion back. And what it may, and you never quite know, because lots of these documents are never public.
Oh, really?
Yeah, like once you don't have enough rights to see them, or control them,
Yeah.
you might never see them.
So where would you say like the sweet spot is then, Doug? Like, is it all to do with money? Like you just put as much as you possibly could in, or is it better to go smaller and enjoy the ride with more businesses, or is it just totally personal opinion?
It depends what you like. I've got friends who do. I did it for amusement to start with,
right?
And then I started doing it as a pure. How could I invest at scale, which is where I ended up. So my goal was to invest in everything that I could and have a little bit on the table.
Mm-hmm.
And what I was really doing was I was building an index of starters in the UK. So my view was tech in the UK was going to explode. All I had to do was hold something in enough companies. So if you include like Techstars and things like that, I have small shareholdings in about 250 to 300 companies across Europe. Now, what that means is I'm probably tracking an index now. So if tech is now worth 4 times it was in 2012, 13, 14, then I'm probably 4 times up on average.
Yeah.
Whereas I have other friends who will have made 3 investments in 3 years. I'm not a big fan of the people in the middle.
Right. Okay.
So what you have is you have people who will make 3 investments. They'll put £100,000 in each, and they'll sit on the board and they'll spend 1 day a week in the business, right? And that I can understand. It makes sense because you're effectively becoming an operator.
Yes.
So it's like running your own business. If you're doing it how I am, and a lot of people have got similar models to me, is you're actually just going, some will win and some will die. I have no say really in what goes on. I can help where I can, but effectively I'm just going to be a tracker on the index.
Yeah.
What I find really confusing is the people who sit in the middle. The people who have got 15 investments have never got enough money on the table to care if it wins or dies, they win or lose.
Yeah.
And they never have enough money on the table to even have an influence.
Mm-hmm.
And they don't have enough time because, you earn 15 of them. The best you're going to do is 1 day a month. So it becomes like, I view it as bad stock picking, doing sort of 3 a year and handling them and manage them, and having enough money on the table that the founders care about what you think and will do what you advise. I can see the logic. I can't see the logic when you have to turn up I've been in board meetings where people have turned up in the board and they have no idea what the company does and have not read the board packs or anything.
Yeah.
And you're just like, why did you even come?
But is that a bad stock picking, or is it just like a vanity project? Do people just want to say that they're investors, or?
I think they do until they start realizing that they've lost money.
Yeah.
They lose interest after that.
Yeah. I mean, I see it now more than anything else. It's a kind of getting a sort of trendy buzzword now, being a serial entrepreneur and investor.
Yes, very much so.
So you must be able to kind of see through some of that pretty easily then.
Well, I'm quite contrarian in how I view a lot of this.
Yeah.
I view also, I always used to say to startups when they used to see VCs, I used to say, especially more on the VC side, I said, remember, they've got a job. You think they're all powerful. They have £100 million, right? They live in central London, okay? The economics of the fund, I don't know if this is a place, but the economics of how a venture fund works is if you've raised 100 million of institutional money, you probably told them that you'll get them 3 times their money back in about 15 years.
Right.
Right? So they have huge pressure on themselves to build that. Now, if we take that, their 100 million ends up owning 20% of some companies, okay? That means those companies, to make their 300 million, those companies have to be worth 1.5 billion, right? At an exit within 10 to 15 years. So when I used to say to people, people who had really interesting businesses, and growing really fast, I went, this guy's got a job, right? He has to find a £1.5 billion company, right? There was 4 in Europe last year. These things don't exist. You have something really interesting. You might be one of them, right? I've no idea, but there's something in what you're doing. So don't go in and say, please, 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 sir, give me some money.
Yeah.
You go in there and you're like, I've got what you need. I'm the solution to your problem. Because these guys, like, you imagine if I'd given you £100 million and I'd said, go on, Ian, you promised me you would get me 3 times return, right? All of your friends now know that this is what you do. And you're probably in central London, you're probably paid somewhere between £100,000 and £200,000 a year, which isn't going to get you that far in central London. It might get you a 1-bedroom flat on a mortgage.
Yeah.
You see what I mean? I was like,
Yeah.
You're living a very stressful life as a VC. Now, admittedly, some of them, have come from wealth elsewhere and have made companies elsewhere.
Mm-hmm.
But if you're a 25-year-old or a 30-year-old and you've been to university and this is your job, you've got to deliver something.
So, Doug, before we wrap it up, I want to ask you a question about when is it right to take investments? So you've got a company that's ticking along, it's doing okay, it's making sales. It might be 2 years old, but after 6 months, it's starting to make a sale, it's doing all right. is it sometimes not right to look for investment and just grow organically instead? Or is it really just dependent?
I would say most times it's not right.
Right.
We've never raised money at all. I've built numerous companies. I've never raised a penny for anything.
Yeah.
And the reason why is because I sit there and I go, I get to do what I want.
Yeah.
And most people forget that when you take money from someone, you actually have given them a bit of control over your life. Whether you like it or not, that's what's going to happen. And I'm very much like of sitting with founders like, work out what you want. That's the most important thing. If you vehemently want to build a big company and you want to do it fast, you're probably going to have to raise some cash. Now, if you're going to raise some cash, you need to work out how you're going to raise it and who you're going to raise it for. But in most cases, why bother? You can build, it sounds horrible, but you can build a business. Let's say, assume that, the waves are right and you've got the right talents, and the industry's growing, so on. You can build a business, you can make yourself 50 or 100,000 quid a year. And actually, once you've got it working, especially in tech, I had other businesses in real world. Tech isn't like anything else. You can build businesses in tech without knowing anyone, without having to go and see anyone. You can rank in Google, you can do paid search, you can send emails, and all you have to do is care about that bit of the business. And it might, I have friends who literally do half a day a week. They spend 5 or 10 years building something.
Yes.
Quite useful. If I look at car rental business we built, we had 5 years of building it, getting traffic, ranking, trying to get deals with everybody. And then it just kept renting cars. We didn't know where the visitors came from. They just turned up on our website. They rented a car, they left, and Hertz sent us some money. You see what I mean? And you're like, and there's lots and lots of examples of that. They don't get portrayed in the angel or the investor world, because lots of these guys just sit there at home, taking the kids to school and going, I've got a really nice life.
Yeah, and that's what it's all about, eh?
Yeah, but I think there's a big hype of watching TechCrunch, reading TechCrunch.
Yes. And
getting rah, it's the only thing to do. And I had a conversation with some people yesterday, and I was like, they've raised some money in investment, and I sat and I was like, the investor probably doesn't like you, because you're not hitting any of the metrics that your VC would like.
Mm-hmm.
And I said, why didn't you just give them an offer? I was like, just buy their shares back. Give them 10 pence on the pound. You got to think is, again, you're not going to be the $1 billion company they hope you were going to be.
Yeah.
So they don't care anymore. You're a rounding error. You're an admin pain. Go and sit in the bar with them and say, look, I don't know. You gave me £1 million. I tell you what, I'll give you 100. Right? Because also remember, the VC is planned that they have to exit. And if you've turned it into a really cozy lifestyle business with no exit plan,
yeah,
what they've got, they have to have a board meeting with you every month where you go, no exit plan. And they have to write accounts on it. It's like, just give them a way out.
Yeah. Well, Doug, that's been fascinating. The time has just flew, man. I've really enjoyed
52 minutes.
I know. Listen, thanks so much for your just open, honest approach. It's been amazing. Like I say, it's been fascinating. And I think it was needed, Doug. I really do. I've asked you a few questions there that people, I'm sure, would have wanted to know the answer to, because unless you've lived in this world, sometimes you just don't get it, And I know I've got lots of listeners who want to start a business, who think, oh, well, we'll grab some investment, and the question I asked you at the end there, is it right? How do you know when it's right? So I'm sure that's been very insightful for the listeners. So thanks very much, Doug. Much appreciated, and thanks for your time. Thanks to Doug Scott there. Unfortunately, I lost a connection to Doug then. He didn't say bye to us, but he did. He continued chatting with me for another 45 minutes after that, actually. I really enjoyed that insight, so thanks, Doug. We did well to get him along on the show, actually, as Doug doesn't really do things like this. And that's down to you guys, supporting the show, helping bring fantastic guests to our earbuds, so well done. Do let me know how you found the episode. You can find me on all the usual channels. Head over to industryangel.com and there'll be a page there for Doug in the show notes. I hope to see you at the live podcast next Tuesday. We'll be going live on Facebook and Twitter as well if you can't make it, so don't worry. So until next time, I'm Ian Farrer. This is the Industry Angel. Thanks for listening.